Richard Saperstein comes by once a year, Treasury
Our
partners.
people, talk to these people.
You go to Barron's and you open the top 100 financial advisors, wealth managers, and there he's been doing this forever. What was it like the day Bear Stearns was taken out with J.P. Morgan? What was it like? Jamie's standing out front. He's got a gun to his head by the damn building. You were involved in that. What was that moment like?
It was $2. It was $2. That's what we thought about, and how terrible it was, the takeout. But that was the forest fire that we were in that period of time, where you had Madoff decimating the confidence in investors. You had leverage everywhere in the system, and it had to get reset.
And let me not mince words here. The Jewish community financially within this island of Manhattan was destroyed. How did you pick up the pieces?
Well, basically, the forest fire killed everything. And that's when I went to Hightower Advisors in May of 2009. And that was the green shoots, the new start for the financial industry.
Let's jump forward now. Paul and I are making jokes about the narratives out there. I've never been so distressed. It used to be simple. Buy munis, buy fixed income, buy some stocks, go to Florida. That used to be the way it worked. How do you treat the cacophony of alternative investments now?
We stay away from alternatives. We're probably 1.5 miles away, and we don't have any reason to be even closer. Illiquidity, lack of transparency, high costs, but I'm not really worried about a credit bubble right now or a blow up in credit. Our playbook is simple. Large over small stocks, U.S. versus non-U.S. stocks, okay, and developed markets over emerging markets. That's the core playbook, and that's worked for years. We'll continue to do that, and add municipal bonds, as you mentioned, because value is great in that market now with the equity component of a client's portfolio.
So large cap equity, been a great place to be. Do I take some money off the table here?
It depends if you're underinvested in large cap tech, because large cap tech will drive markets into the future. Remember, all of us in this room go back to the IBM Selectric typewriter, 1982, 1983.
Alexis has no clue what you're talking about.
I was but a babe, but I do remember.
It was evolutionary. And now we are seeing the trend from the Selectric to the PC to mobility to the cell phone, all the way up to the cloud, the internet, okay? Now we have AI, and it's going to bring technology forward. The key to investing in this is to find the companies that are generating cash flows, not the startups where there's higher volatility, but the core emblematic companies in the sector is where we're putting our capital.
So how do we think about the fixed income market here? Municipal bonds is something that you guys characterize as a highly overlooked asset class. How do you look at munis today?
All right. So if you remember very well, zero interest rate environment from 2008 for 20 to 23.
Yep.
So that's 15 years. Anyone who's got into business at age 22, all right, they're age 37, and they don't really have any clue what a municipal bond is. So it's a far overlooked market.
Good point.
And so what we have now is rates that are up over 4.5% tax-free, equivalent to 9% pre-tax equivalent.
I got time for this. It's really important. We're going to get to the market opening here. The YouTube industry of financial advice is popping 6 and 7% on a retirement account to use for income. Can you go that high? Or are you still down at a Saperstein 4%?
Credit spreads are very low, and that is not possible without taking credit risk.
See how
there you go. There you go. You gave him a time limit, and there you go.
We're going to continue. Richard Saperstein with us. Thrilled to have him here. Treasury Partners is the firm. Just can't say enough about the simplicity of his vision earned over decades. With us, Richard Saperstein, Treasury Partners, a wonderful annual visit, maybe even twice a year we'll do. Where are you on commercial real estate? All sorts of people you talk to are generational owners of commercial real estate. Is it come back, Paul?
Yeah, absolutely.
It's come back.
I think it's come back. I think, look around, except for 58th Street in Lexington Avenue.
Has it?
I'm not really invested in it, but I can tell you that if we have rent control and we don't allow for rents to increase, then building owners are unable to reinvest and do CapEx in their buildings, so that you get a deteriorating housing stock. And ultimately, that's what will happen. Right. So we have to work a balance in affordability, which is critical, create new housing units, while enabling the existing owners to reinvest into their buildings.
Richard, one of the exciting new markets really over the last 10, 15 years has been private credit. And it's been such a growth market for global Wall Street. How do you guys view that? Do you try to get some exposure there?
Exceptionally little exposure, as I mentioned previously, we stay away from, in general, the alternative space. There are some credit managers who have done a fine job. They'll continue to do a fine job. But it all depends on how you want to structure a portfolio with volatility and illiquidity. Mm-hmm. Yeah. And the funds basically have their challenges. The current environment where there was some fraud-induced bankruptcies, all right, I don't think that's emblematic of what things are doing right now. I think the economy is still relatively strong. Cash flows are being generated. So I'm not really concerned about an overall, macro decline in credit.
Set up for equities in 2026. How do you feel about it?
Favorable. We've got a relatively healthy economy, low unemployment. We have somewhat of a neutral to accommodative Fed. We've got the benefits coming up of the One Big Beautiful Bill. We've got tax policy. We've got full depreciation. So there are a host of issues that should enable earnings to continue to grow. And that's why the backdrop for equities should be favorable.
Richard, thank you so much for coming back.
Yep.
Richard Saperstein with us with Treasury Partners. Can't say enough about the heritage of just trying to get through the year, get through the decade with capital. And, the message there. I like the message of respect for alternatives, but a little bit of careful
that's no worries.
review.
Yep. We talked to the average RIA, and they've got 20-25% exposure.
Exactly.
I was shocked when I learned that.
ETFs, what do you do with ETFs? You like ETFs?
We are big fans of ETFs. All of our equity portfolios are, on average, 30 to 50% ETFs.
Okay.
Low cost, direct drive, efficient.
Right.
We can capture a sector or the market.
Right.
It's a great application of equity exposure for clients.
Richard, thank you so much.
Boom.
Greatly appreciate it.